Imagine you're shopping. Doesn't matter what. A jacket, a new phone case, concert tickets, whatever. You get to checkout, you see the total, and right underneath it, there's a second option sitting there, just as prominent as the Pay in Full button. Pay later. No interest, no fees, nothing due today.
You've seen this 100 times by now, on 100 different sites. It's not hiding in fine print, it's front and center, sometimes bigger than the regular checkout button. And it doesn't feel like debt. It feels like a setting you toggle on, the same way you'd pick standard shipping instead of express. A convenience, a preference, nothing heavier than that.
So here's the question almost nobody asks in that moment, standing there with their cursor hovering over the button. If this is genuinely free, if nobody's charging interest, nobody's charging a fee, where is the money actually coming from? Because it has to come from somewhere. No company hands out free money at scale as a personality trait. There's a business model underneath this button. And by the end of this video, you're going to see it clearly enough that you'll never look at that checkout screen the same way again.
Let's start with how fast this actually happened, because the speed itself is part of the story. Buy now, pay later. Companies like Klarna, Afterpay, Affirm, Sezzle, and a growing pile of others didn't exist in any meaningful way for most online shoppers a decade ago. Today, depending on which survey you look at, something like a third to half of online shoppers have used one of these services. That's not a niche financial product anymore.
That's a fundamental shift in how an entire generation of people borrows money to buy things. And it happened almost silently, without the kind of public debate that usually surrounds a new form of consumer debt, because nobody's calling it debt. They're calling it flexibility.
And that framing is doing an enormous amount of work. A $200 jacket doesn't feel like a $200 decision when it's broken into 4 payments of $50, spaced 2 weeks apart. Your brain processes $50 4 times completely differently than it processes $200 once, even though mathematically, absolutely nothing has changed. The item costs exactly the same amount. You're taking on exactly the same total obligation. But the psychological weight of that decision has been cut into pieces small enough that your brain doesn't flag it the same way. This isn't an accident of good design. It's the entire point of good design, from the company's perspective. The smoother and lighter that decision feels, the more often you say yes to it. And the more often you say yes to purchases you might have paused on or skipped entirely if you'd been staring at the full number.
So we've got a checkout button that feels like a convenience, marketed as free, spreading across an entire generation of shoppers in just a few years. That's the setup. Now let's get into where the actual money comes from, because it's not nowhere and it's not from goodwill. Who's actually paying? There are 3 places this money comes from, and once you see all 3 together, free starts to look like a very specific marketing choice rather than an accurate description.
The first is the merchant, the store you're actually buying from. Every time a shopper checks out using a buy now, pay later option, the store pays a fee to the BNPL company for the privilege of offering it. And this fee is often meaningfully higher than what that same store pays for a regular credit card transaction, in some cases several times higher. Now stop and think about that for a second. Why would any store agree to hand over a bigger cut of every single sale? Stores don't do generous things for no reason. They do it because the data backs up something specific. Offering a pay-in-4 option increases both the size of the average order and the number of times a shopper checks out at all. People who'd hesitate at a $200 total will often go through with it instantly when it's framed as $50 today. So the store is making a calculated trade. Give up a slice of each transaction in exchange for more transactions happening in the first place, and bigger ones when they do. The fee isn't a mystery. It's a cost of doing business that gets built into the price of the product long before you ever see it.
which means, indirectly, everyone shopping there, BNPL user or not, is a little bit subsidizing that fee through the base price of the goods.
The second source is late fees, and this is where no fees quietly stops being true. Miss a payment, even by a day, even because your bank account happened to be a little short that week, and a real charge shows up. Sometimes it's a flat amount. Sometimes it's a percentage of what you owe. Sometimes, depending on the provider, it's both stacked together.
And here's the mechanical detail that makes this worse than it sounds. A lot of these plans are set up to automatically charge the card on file on the due date, whether or not the money's actually sitting in that account. Which means a missed BNPL payment doesn't just trigger a BNPL late fee. It can also trigger your bank's own overdraft fee on the same failed transaction. So one missed payment quietly becomes two separate penalties from two separate companies for the exact same shortfall.
The third source is the one that gets talked about the least, and it's your data. Every purchase you split, every category you shop in, every price point where you decide, yes, I'll break this into payments, all of that becomes a very detailed profile of how you spend money and where your financial pressure points sit. That profile has real commercial value. It can be used to target you with more offers. It can inform what gets recommended to you. In some cases, it can be sold or shared with partners entirely separate from the original purchase. You're not paying with money for that part. You're paying with information about yourself, which is arguably more valuable to the company long-term than any single late fee would be. Put those three together. Merchant fees baked into prices, late fees triggered by ordinary bad luck, and a data profile built quietly in the background. And no interest, no fees turns out to mean something much narrower than it sounds like at checkout. It means no fees if absolutely everything goes right every single time for as long as you use the product. That's a much smaller promise than the button makes it sound like.
On the surface, that sounds like a benefit. No risk to your credit score just for using it, right? But flip the perspective around for a second and think about what a credit report is actually for. It exists so that a lender, a bank, a car dealership, a mortgage company, can look at your full financial picture before deciding to hand you more debt. It's a shared visibility system. Everyone reports in so everyone can see accurately what everyone else owes.
Now, imagine a big and growing chunk of people's actual financial obligations simply isn't part of that system. A bank looking at your application for a car loan has no idea you're currently juggling 3 or 4 active pay-in-4 plans running in the background across different apps. Neither, frankly, does the next BNPL provider you sign up with. They can't see what you already owe somewhere else either, because none of these companies are required to share that information the way credit bureaus force credit card companies to.
That's not some old system that just hasn't caught up to new technology yet. It's a structural gap, and the industry has had very little financial incentive to close it quickly, because invisible debt doesn't scare off new borrowers the way visible debt does. If applying for your 4th BNPL plan actually showed a lender, or even yourself, a running total of everything else you're carrying, a lot fewer people would say yes to the 4th one. The invisibility isn't a side effect. It's part of what keeps the growth curve going.
Real quick, if this is the kind of thing you find yourself thinking about after you close the tab, that's genuinely most of what we do on this channel. Subscribing to Compound Economy means you don't miss the next one, and it actually helps a lot on our end. So if you're enjoying this, now's a good moment to hit that button. Okay, this next part is the one that actually worries the people who study this stuff for a living.
One buy now, pay later plan, by itself, is genuinely manageable for almost anyone with a steady paycheck. $50 every 2 weeks for 2 months is not a hardship for most people. The real problem shows up when it's not just one plan.
Picture a fairly ordinary month. A pair of shoes bought through one app,
a last-minute flight booked through a different provider built into the airline's checkout, a piece of furniture split through a third, even a grocery delivery, in some markets now, split through a fourth. Each one, on its own, looks completely reasonable. Each one passed the same mental test. It's just $50 twice a month. That's nothing. But none of those 4 apps talk to each other. There is no single dashboard anywhere that shows you all 4 due dates lined up next to each other. You are the only person in the entire system holding the complete picture. And human memory turns out to be a genuinely bad tool for tracking 4 separate bi-weekly withdrawal dates spread across 4 separate apps, especially when new purchases keep getting added to the pile before old ones finish paying off. Here's how it actually breaks. 2 of those due dates happen to land in the same week. Not because you planned poorly, just because that's how the math worked out once you had 4 plans running instead of 1. Suddenly, you're short. Not because you're bad with money, but because you were only ever tracking each obligation individually, the way each app presented it to you, and nothing in the system ever forced you to add them all up. That missed payment triggers a late fee from the BNPL provider. The failed auto charge attempt often triggers a separate overdraft fee from your actual bank, hitting the exact same shortfall from a completely different direction. And now, you're not dealing with one problem, you're dealing with 2 penalties, stacked on top of each other, for a gap that might have been avoidable if you'd simply been able to see the whole board at once. This happens to people with steady jobs, people who consider themselves reasonably careful with money. It's not a story about carelessness. It's a story about a system that was never designed to show anyone the full picture, deliberately or otherwise. And that gets more dangerous the more of these plans a person is juggling at the same time. There's a well-documented idea in behavioral economics called the pain of paying. The discomfort your brain registers at the exact moment money leaves your hands. Cash triggers it hardest because you physically watch it disappear. A credit card swipe triggers it less because the money's abstract and the bill comes later. Buy now, pay later goes a step further than either of those. By splitting a single purchase into several smaller, separated moments, it reduces that pain of paying 4 separate times instead of concentrating at once. And each individual pain point is small enough that it barely registers at all. You're not avoiding the total cost. You're avoiding the one moment where your brain would normally do the math and flinch. This is also why BNPL is so aggressively marketed at the exact moment of purchase, rather than as something you plan ahead of time. It's not designed to help you budget in advance. It's designed to remove the hesitation at the single moment you're most likely to say no, the number on the screen right before you commit. Credit cards took decades, genuinely decades, with a lot of documented consumer harm along the way, before serious protections showed up. Mandatory disclosures, interest rate caps in some regions, statements required to show you exactly how long it'd take to pay off a balance, making only minimum payments. Buy now, pay later mostly grew up underneath all of that. A lot of these plans are structured just differently enough legally from a traditional revolving credit product that for years, in most places, they simply weren't required to follow the same disclosure and protection rules a credit card has to follow. This isn't necessarily because regulators decided it was harmless. It's largely because the industry grew fast enough that the rulebook is still catching up, which is a pattern that shows up over and over in financial history. Whenever something new gets marketed as fundamentally different from an old regulated product, even when it functions almost identically underneath. That's genuinely starting to shift now. Regulators in several countries have begun writing specific rules for this category, treating it more like the credit product it actually is, requiring clearer disclosures, and in some cases, pulling it formally under existing consumer credit law. But for years, and in a lot of places still today,
This operates in a gap that most users have no idea exists, simply because nobody explains it to them at the one moment it would matter, right there at checkout.
This isn't a story about people being bad with money, and it's worth being direct about that, because it's an easy story to tell wrong. Usage skews heavily toward people already living closer to paycheck, which makes complete sense once you think about why the product exists at all. Splitting one large expense into smaller pieces is most valuable precisely to someone whose cash flow is already tight, because it's the difference between "I can't afford this today" and "I can afford this in pieces."
That's a real, legitimate financial need. It's the same underlying need that's kept products like payday loans and rent-to-own furniture in business for decades, often at far worse terms than BNPL. Not because the people using them are careless, but because smoothing out uneven cash flow is a genuine problem, and expensive products keep getting built specifically to sit in that gap.
The uncomfortable part is that the people most likely to need this kind of flexibility are also the people with the least room in their budget to absorb a surprise fee without it knocking the rest of their month off balance. A missed payment that's a minor annoyance for someone with savings sitting in the background can be the difference between making rent on time or not for someone without that cushion. The product doesn't discriminate on paper. Anyone can use it. But the actual harm it causes isn't distributed evenly at all.
None of this means buy now, pay later is automatically harmful for every single person who's ever used it. Plenty of people use one plan at a time, pay it off exactly on schedule, and it genuinely costs them nothing extra. The danger was never really the tool itself. It's the invisibility around it. No unified view of what you actually owe across providers, historically weaker protections than a credit card carries, and a business model that structurally needs a percentage of users to slip in order for those late fees to matter to the bottom line.
If you do use these plans, the fix is almost boringly simple, even if very few people actually do it. Know exactly how many plans you're running at any given time, not roughly, exactly. Write every due date down somewhere you'll actually look at, not just trust to memory scattered across 4 different apps, and treat the whole thing exactly like what it is: debt. Because that's precisely what it is, regardless of whether it happens to show up on a credit report or not. So the next time that For Payment button shows up at checkout, sitting there looking just as friendly and low stakes as free shipping, you'll know exactly what's underneath it and exactly who benefits when things don't go perfectly. If you found this useful, subscribe to Compound Economy.